I think another advantage that you have to mention when you're talking about life insurance versus the 401k and that tax-free retirement piece is there's no required minimum distribution, so no RMDs like you would have on a traditional qualified plan. The big thing about life insurance policies, especially for retirees, is it provides greater freedom over any kind of financial strategy by eliminating the RMD, uh, which is required by 401k plans. Like what that means, Ron, is a lot of people, they can control when and how they access their money. They make it easier to manage their taxes, preserve wealth, and adapt to any kind of changing financial needs that they have during retirement. I think it's important to mention one of the major benefits of life insurance is the absence of that required minimum distribution. It just gives you more flexibility than a traditional 401k. And with the 401k, you're required to start taking that RMD at age 73. Like it's mandatory withdrawals, they're subject to income tax, and they continue year after year, regardless of whether you need the money or not. Like your partner, the government, is going to require that they get their portion out no matter what. And it leads to significant tax burdens during retirement, and it potentially pushes you into a higher tax bracket, which is what a lot of people don't think of. And it can also limit your financial flexibility. Um, Life insurance, on the other hand, it doesn't have any RMDs. So you can leave the funds in your policy as long as you want to let it grow. You can tap into the cash value whenever it suits your financial strategy or specific needs. And the flexibility, it allows you to control the timing and the size of the withdrawals. And it helps you better manage your taxable income through retirement, especially for those who don't need immediate access to funds or who want to leave a financial legacy. Life insurance offers more control compared to the mandatory nature of any kind of 401k distributions. Uh, a main thing, Ron, is because life insurance policies allow you to access your cash value through those tax-free loans, you get to avoid triggering any unnecessary tax events. That control, it can be particularly useful for retirees who want to minimize taxes and avoid impacting other benefits like Social Security. And that ability to decide when and how you want to use your accumulated funds make life insurance a valuable tool for those looking to maintain financial flexibility while managing tax exposure later in life.
Yeah, I mean, I think that's a a valuable piece, and I think a lot of people kind of forget, if they have other assets that they've been fortunate enough to build, those going back to those buckets that we've talked about, where you have other means for income, and then all of a sudden you kind of don't need maybe the 401k. Not a lot of people fall into that mix, but it does happen. That R&D factor, you kind of forget. It kind of sneaks up on you. It's like, oh, wait a second. Now I got to start taking this money that the government's going to force me to take this because I've deferred this my entire life. Well, Uncle Sam wants their piece back that you've deferred. So that RMD becomes a relevant piece as you get older. If you've been fortunate enough to build other buckets and you don't necessarily need that money, but now you're forced to take it out. Now it becomes a question of what do you do with those funds? Because you pay tax on it now because you're required to take those out. Now I've run into that several times with people, many times with people that, hey, I don't necessarily need this money, but I'm forced to take it out. And I've seen people reload this money into another mechanism that is in another taxable event again. I see that over and over again. And I just don't understand that thought process. But the RMD is something where if you're trying to leave legacy, possibly for heirs, maybe it's children or a charitable organization or something along those lines, but you're being forced to take this money out because that's the way it's structured in terms of deferred money. Understanding that that's not the best avenue to be able to leave legacy behind is in vehicles like that, because then that is still set up for the beneficiaries to still have to be obligated to pay taxes. That doesn't excuse them from paying taxes. So RMDs, even though you're living through RMDs, as long as there's money left that's being passed along and you don't need that income, you have to take it. And then that beneficiary is going to be required to pay it if there's money left over. So these RMDs can become interesting for those that don't need the money, but those that do need it, you know, RMD does not become a factor if you're taking income prior to age 73. So you're meeting that. That's something I want to make sure people understand as well, is if you're already meeting the obligation and you've reached the age of 73, that required minimum distribution is being met. So now it's not a secondary requirement to be taken out. So just want people to understand that also, it's not a double hit. As long as you're meeting that minimum requirement based on your distributions prior to age 73, they're not going to start a new level of income coming out. So, but if you are not exercising money, then this becomes a factor down the road because there are people that run into this where they don't need the money, fortunately, but they have to take it out. And now it's a matter of now where do I put it? So those are things to think about.
Yeah, and I think a lot of people don't think about it early enough because we see this in our clients' face, like when they're reaching the age of 70, 70, I'd say 68, 69, 70. This is when the RMD starts to become a real thing, especially for those people who don't need the income and would rather leave it in and get the more growth. But it's something you got to think about at an early age in your retirement when you're starting to save for retirement. That RMD becomes a factor later, and we see it every day. It's almost like a weight around somebody's ankle. You know, like the ball and chain, they're carrying around the RMD that they're going to have to take out on their money, and it's a real factor when they get to that age.